Conversations with Frank Fabozzi. I'm Frank Fabozzi. This series is brought to you by the CFA Institute Research and Policy Center. My guest today is Ludovic Phalippou. Luda, right? Okay. Ludo's a professor of financial economics at Oxford University who specializes in private market investments, focusing on fee tracking and interest alignment and return benchmarking. You'll see he's has a lot of interesting things to say. He's not a very popular guy in the industry. He's had some interesting debates with actual hedge fund manager. He's the author of the bestseller Private Equity Laid Bare. His paper on private markets was one of the 3 2018 recipients of the Jack Trainer Prize, sponsored by the Q Group, very prestigious award. Here in the Masters in Economics and a Masters in Mathematical Finance, both from the University of Southern California, and a PhD in Finance from INSEAD. Welcome, Ludo.
Thank you.
How do you view the current state of the private equity industry, particularly considering recent macro economic volatility and rising interest rates?
So I'm not sure there is more volatility now than in the past. I haven't tracked the volatility indices, but I'm not sure they're much higher than in the past. And particularly, as don't find whenever there has been short-term volatility, that's not a big deal because their capital structure, even though is very use a lot of debt, they have a lot of flexibility built in, like credit lines and so on. So usually, small volatility, economic volatility is not a problem. The rising interest rate is a big deal. So I have an old paper already 10 years ago when we looked at what was the drivers of individual leverage buyout returns. The number one variable was the evolution of interest rate during the life of the investment. So if interest rates had gone up during the life of the investment, the returns were terrible. And if they had gone up, if it had gone down, it was very good, and if it had gone up, it was very bad. And we prove why this was really like the causal channel and the primary channel. Now, even casually looking nowadays, it seems to be a major issue. What happened basically is that you do have some people who have hedged the debt, but usually think of it about like 500 basis points above the base rate. So when the base rate was 0, they would have 5% interest to pay. To do some back of the envelope calculation, a debt would typically be 6 times EBITDA. At 5%, 6 times EBITDA, it's a third of your EBITDA-ish that would go in interest payment, which is aggressive, but if you have some credit line built in and so on, it's not the end of the world. When the interest rate goes from 0 to 5% and you haven't hedged, some people did, most didn't, you are 10% due. And when you are 10% interest, it means that the interest alone is now 2/3 of your EBITDA. And when EBITDA, you have 2/3 of it that needs to go just for interest payment, not even like repaying the capital of your debt, not doing anything else that you are supposed to be doing out of EBITDA, including maintenance and capex, etc. You're in trouble. Like it's 2/3 of an EBITDA just going on interest payment is impossible. So, and that's like the average firm. And so the industry is under massive pressure, and so they renegotiate the debt so that they don't officially, have all these companies going bankrupt, because the guys also who lend them the money, who are typically private credit funds, they have raised that money themselves from someone else. They don't want to tell these people this is not going well. And so everybody is kind of colluding, saying, let's just postpone some interest, transform some type of debt into another one, and things like that, so that we don't, officially have a wave of bankruptcy. But we do see major bankruptcies, but not a wave of, like you would expect if 2/3 of your EBITDA would go in interest payment. Like it would violate about any covenants, even if they are light, you would still violate whatever is left there. So the increase in interest rate has this dramatic effect. The portfolio companies are in trouble. And 2, it also means that the value of an asset, if interest rate goes up, as you know all too well, the interest goes up, the value of an asset should go down. the seller doesn't want to sell at a loss. The buyer has in mind the new price. They are facing the high cost of borrowing, so the buyer is not going to buy at the old price, but the seller doesn't want to take a hit on the price. And so then you come to a standstill where then people say, okay, then I just don't sell. And so little transactions mean the money doesn't go back to pension funds and the like. And usually this money is used to commit to new funds, and that doesn't then happen because the money is not coming back. And so fundraising is in trouble. And so the industry is in a situation that is probably the worst one that it has been over the last 25 years. And 25 years ago was just even venture capital in trouble. The leveraged buyout industry has probably never been in that kind of trouble.
That you've been vocal about the lack of transparency in private equity reporting. What steps would you recommend for improving disclosure and governance practices across the industry?
In a sense, to make it as simple as possible, the short answer would be the book has been written for mutual funds. Just use that book for private equity funds. So, as you know, mutual funds used to be unregulated. 100 years ago in the US, the SEC didn't exist. Insider trading was allowed. Mutual funds could advertise their track record the way they wanted. They could incubate funds if they wanted to, and therefore artificially create good track records. They could do late trading. They could do anything they wanted. Right? And it is when the data became available, we had a wave of researchers in the 70s, and then even more so in the 80s, and even more so in the 90s and early 2000s that wrote thousands, literally thousands of papers on mutual fund managers' behavior. And a lot of these papers demonstrated that there were issues. They were not acting in the best interest of clients. They were using all kinds of tricks. They were misleading clients in all kinds of ways. And all this research led to the SEC adding one rule after the other. Like, if you incubate mutual funds and then present this track record of an incubated mutual funds, there needs to be a disclaimer that you have incubated that stuff. If you are not allowed to do late trading for your best clients, you cannot, you have to separate the fees, and you have the 12(1)(b) and etc. And you have a standardized way to report your performance, and a standardized ways to calculate your fees and to report them, because mutual funds were free to report whatever fee they wanted to. Some they didn't want to report, some they, right? And there are all kinds of ways to hide the fee. And private equity is like mutual funds 100 years ago. Like, it's whatever. I report some of the fees, some expenses I don't report if I don't feel like it. And the returns are reported in a format that is actually pretty misleading for the average investor, even for actually advanced investors. So the short answer is just like, you do it just like the rules have been written for mutual funds. Most of them would apply to private equity for the same reason.
Well, I mean, one even more complex aspect of this is pricing, marking to market the positions. At least with mutual funds, you had typically exchange traded securities. Here, the issue of valuation becomes very difficult.
It is, but it's not unusual. We had these issues with hedge funds, and we invested in illiquid things, and there have been lots of lawsuits in the US because when you allow people to trade at NAV and the NAV is incorrect, you will have lots of problems. And private equity is going that direction because now increasingly they have these semi-liquid solutions, how they like to call them, which is a pretty name, but it's very very tricky on the legal side.
Let's talk about value creation. Private equity firms often claim to create value through operational improvements, but critics like yourself argue much of the returns come from financial engineering. How do you assess this balance in today's market?
I am a critic, but I don't think I've made that argument. But
Right.
it's because it's a weird argument. People often say, is it operations or is it financial leverage? Like when they present it as if it's a substitute, it's one or the other. It's a complement, so it doesn't work. So the analogy I often use with my students, because I think is the most intuitive for people, is that take a house. So imagine you bought a house for 100 and you sell it for 150. So the industry likes to call that value creation. 50 was created. Okay, I have a major issue with that, which is, as you know, the market might just have gone up by 50, and so you sold your house for 50 more just because house went up 50. Okay, this is not value creation. It could also be that it went up by 50 because at the expense of some other things, etc. So like this already the notion of value creation, it's problematic the way it's defined. But let's accept the industry definition that the 100 to 150 is operational value creation. With zero financial leverage, you got 50% return. If you had 50% leverage, so you had a 50 million loan and 50 million of equity, and you sell for 150, abstracting from the slight interest you had to pay, you tripled your money. Now we are talking about a 200% return. So you will have financial leverage being a complement of operational leverage, in the sense that if you got 50 of operational leverage, when it becomes 100 of total value creation, if we can call it this way. But if you have zero operational value creation, so if you bought your house for 100, you sell it for 100, you can have levered up the way you want. You will not have made more money with it, and if actually you sell your house for a lower price, you will destroy more money if you have levered more. So this is very basic finance 101. And so this notion of like, is the money coming from financial leverage by itself does not add money. In fact, in this example, very simple example, you can take money out, and operational value creation will bring always a little bit, but needs financial leverage to amplify it. So these two things are complement and not substitute. So it's not one or the other. We have quite some evidence that in terms of pure profits of companies, they go up quite substantially when they're under private equity control. And for one very clear reason is that the management is incentivized on that, like to magnitudes to the tune of that we never heard of, or can even sometimes like picture. So when you incentivize the management so much on like the value price of your house in 5 years, the price of a house is higher 5 years later. And so the profit of companies do go up, the value of the assets do go up substantially on average, and the financial leverage amplifies this increase. But a lot of money is charged in fees, and then we can debate whether there is anything substantial left for the final investor. But there is hardly any evidence that there is no considerable increase in profits of companies when they're under the hands of private equity. Everything points to them increasing the value of the companies substantially. Is not necessarily value creation, but the earnings of companies are going up in the hands of private companies, more private equity held companies, more than with other companies, and financial leverage amplifies that.
When I was on a board fund, a very large asset management firm, I've had to retire since because of my age. We used to get information for both private equity deals and for private debt deals. And what we used to get was information on ESG. I don't know where they got the information from, okay? But do you see ESG as a true driver of value creation or more of a compliance exercise for private equity firms?
Yeah, this is it would require quite a long answer, because the ESG thing is, so first, ESG is not well defined. We would have to spend quite some time defining it. Different people mean it in different ways. So there is quite a lot to unbundle there. And so I'm trying to write an entire book just to do that. And I read in 200 pages to get to answer your question. But if I try to give a simple answer with like the most common definition is that in private equity firms, there will be some specialists of environmental issues and employee issues, like diversity and then employee well-being. And then the question is, can you add value? So can you contribute to the increase of the value of a company by having some people specializing in environment and social issues in your private equity firm? The answer is yes. Sometimes yes, and then often not. But there is no reason that to think that this person cannot be useful, right? So they're having somebody who knows the environmental regulations and laws and knows how to improve employee morale and things like that. This person will be useful. So if that's in that sense, and that's often how people present it, in that sense that a source of value creation, yeah, it can be. There is no reason why not. Just like having an AI specialist in a private equity firm can bring something to some companies, not all. And just like having a specialist of cybersecurity can bring a lot to some companies and not to others. And so there is nothing special about ESG, but that's not the reason people make a big deal about ESG is because it's what people hide behind it. There is an ideology about how companies should be run more for like the benefits of society, avoiding negative externalities, etc. And they mix all kinds of notions together that shouldn't be mixed in order to try to get their categorical imperative through into a company. So the short answer to your question is yeah, some ESG specialists in a private equity firm can help improving profits of companies. Can happen. I think it's more the exception than the rule, but yes. And is it a compliance exercise for private equity firms? Often, because first, now there are some regulations in Europe, but also a lot of the LPs are people who are in the camp of pro ESG people, and private equity fund managers tend not to be. And so then, but they have to please their LPs. And so the LPs will always say, what do you do for ESG? And so then the other guys have to pretend they care and say, yes, we have increased the number of female here. And then we have we have created jobs and blah, blah, blah. We'll write you a report, the nice looking one for you. And then, you're happy and we're done. So there is the box ticking thing happening. And the value creation angle as it is often presented, yes, it's fine as well, but it's nothing special.
Thank you. In your research, you've challenged several widely held beliefs about private equity performance. What do you think is the most persistent myth in the industry that needs to be debunked?
I think the number one myth is the one of superior performance to public equity. That I don't say that private equity has underperformed, but it hasn't outperformed public equity by a wide margin, and it's a no-brainer. This is usually how it's presented. Is like, of course, obviously, private equity has done much better than public equity. And what I pointed out is that it very much depends on the benchmark. People are playing with these benchmarks in order for things to look that way, and it's not obvious at all. So that's the top one. The second one is the alignments of interest between LPs and GPs, and that also is a bit of a trick. But there is very strong alignments of interest in private equity, but it's between the GP and the executives. It's between the management team and the GP. And people often use that saying like, oh, there is very good alignments of interest in private equity. Yes, but only for one relationship, not for the other. And when you're talking from the investor's point of view, what matters is whether the LP and GP are aligned in terms of interest. And they are not. The 20% carry doesn't align interest very steeply. So that's probably what I would say is the second biggest myth. The third one is the myth of performance persistence. It's used a lot. It's quite damaging. There's this idea that top quartile private equity firms will stay top quartile. There is performance persistence. The top guys remain at the top. And that's not the case in hedge funds. That's not the case in mutual funds, but it's the case in private equity. And that's not true. And that's very damaging.
What's the most surprising insights from your academic work that you think practitioners in private equity often overlook?
I would guess so a lot of my work is quite technical, so that wouldn't be things that they do on a day-to-day basis. The one that would be like the most practical and that came from my work is just how stupid and dangerous the use of IR is. And it's not that they are not aware that something is going on with IR, because they are aware that this number can be misleading. They are very rarely aware just how deeply stupid and dangerous the number is. So they underestimate how stupid it is, and how meaningless it is, and how misleading it is. And I think, yeah, that's probably would be my main contribution.
You know, we tell our students, even when we teach a very basic corporate finance course, we tell them how misleading IRR is in
Yeah, but
general.
so that's in any corporate finance textbook, but that's probably actually maybe more a curse than a blessing, and that's because in this any standard corporate finance textbook says IR is a problem, and they show it in a case of like a project. And so they show a project with certain cash flows, but these cash flows are pretty normal. It's like you have one investment, two divestments, and they show examples where sometimes the IR and the NPV would disagree, but they are pretty rare. You need to have like a pretty convoluted situation. They show examples where you can have two solutions to an IR. It's very rare situations, very convoluted situations. And so what you get out of this course is that, yeah, my prof told me that IR can be dodgy, but it's like in very convoluted situations. And so I can ignore that and just like move on. And the problem is that the textbooks, people usually don't know private equity. And in private equity, what is different from these project examples that are given in corporate finance textbooks is that you can time your exits, the cash flows are endogenous. And when you can time your exits, and when you can use things like subscription credit lines and things like that, you can get the IR to go completely ballistic. And you can get something like the situation I depict every year. So I'm going to make that post in a few weeks on my LinkedIn. Every year I congratulate KKR for writing in their 10K filings that they've got 26% return since inception. Every year it's 26%. It doesn't change. It hasn't changed for like the last 20 years. And that the textbooks, the corporate finance textbook don't show. They don't show how stupid it can go when you endogenize, when you are able to time the cash flows, and when you're able to use subscription credit lines and the like. And that's a problem, because the standard corporate finance textbook says IR is bad, but it's innocuous if you already read what the textbook says. It's like it's a very convoluted situation where it's not going to work. In private equity, it's a rule. Because IR is deeply flawed, people can time the cash flows and use certain tools in order to get this number to go completely bananas. And that's a big deal.
Well, now we find private equity, which was at one time really limited to the for institutional investors. Now it's increasingly being marketed to retail investors. Do you see this as a positive trend for the industry, or are there significant risks associated with this?
Yeah, so I think it's a terrible thing to allow people who are clueless to invest their money into such vehicles. So often people say, so far it was only for sophisticated investors. I used to joke that I'm very happy to write the sophistication test. I will write the exam, and I'm going to give it to everyone who's said to be sophisticated, and we see how many people are going to get an A on my exam. And I think it will be very few, if at all. So if we now move to retail investors, the fraction of people that really understand that an IRR is completely made up, basically, that understand that a TVPI can be manipulated pretty easily with recycling clauses, the fraction of people that would understand that you may be written 8% hurdle rate on your fund doc, but if there is 100% catch-up provision right below it, it cancels effectively the hurdle rate in 99% of the situation, and so on and so forth. And I can go on and on. And even like the people that are called sophisticated, they wouldn't know most of these things. When you go to retail, there would be no one knowing these things. And yet it's fundamental. I've just given examples of things as fundamental as a track record will be completely misleading and misunderstood, and the terms and conditions will be completely misleading and misunderstood. So, and it's like the two most fundamental things that people would look at when they do an investment. So I think it's a terrible idea, but it's inevitable, because you cannot just say this investment is just cannot be touched by some people and it's okay for some other people. So it's inevitable that you have to let these people in, and they are in. Now, the problem is that it's more a curse than a blessing for the industry, because in the US so far, the administrations have been able to have a hands on the SEC to say, don't touch these guys. Let them just play. It's big boys with big boys. Leave them alone. Okay. When under Biden, the SEC has been a bit more involved. They were a bit more involved under Obama. Under Trump 1, they were not. And under Trump 2, they were not. The problem is that in a country like the US, if you touch retail people, the laws are very protective to them. And the lawyers in the US are like, they are God, okay? Like orders of magnitudes, okay? There are things the US cannot do, like cheese and a number of things like that. But producing top lawyers like that's very, very good. So these lawyers are going to have a feast because they're going to go there and say, look, Joe the plumber was presented a track record that said that this company every single year had like 26% return. But Joe the plumber gave 100 and he got 105 after 2 years. So like, how does that work, right? And it turns out that it's not just bad luck because the older investors didn't get 26% return. It was a 26% IRR, but it was presented like a return. And it doesn't square up with how much the previous guys should have got, even if that would have been anywhere near a return. And then in terms of terms and conditions, my Joe the plumber actually was very confused because he thought that this was how the fees were calculated and so on, but in fact it wasn't. And then Joe the plumber was very surprised that actually he could pay out of fund expenses that wouldn't be like transparent to him. He could pay the private jet of a fund manager directly paid out of the assets that he actually owned, and that there were all kinds of expenses of a type that was taken out of his asset. Joe Plummer was not aware of that, and he's actually pretty outraged and he's upset of this self-dealing and tunneling of money. He assumed it was illegal in a country like the US, and actually there are some laws we can dig out that would say it's illegal. And so I think that at some point, as information will come, there will be a lot of legal activities in the US, and that will then force the regulation like the SEC to go to what I said earlier, which is to have the same set of laws for the mutual funds and for private equity funds, because you will not manage to say it's a retail investors in both cases, but I protect that person tremendously when I'm dealing with public security and not with private security. If you need to protect a retail investor more, it's like public security should be the last one you should go for, because it's already like, how much can you cheat with like public equity returns? It's very limited compared to what you can do with a private company. So if you have the choice between two asset classes to over-regulate to protect retail investors, would be the private one, not the public one. And we are in a situation where retail is mega protected in public markets where the need for protection is the least, and would be zero protected like when you're in a part of the market that is where you need the most protection, because this is the one where there is the most flexibility to hide expenses and fees from you and present to you misleading track records. And so I think, I don't know if it will happen in 10 years, this wave of lawsuits, in 20 or in 5, but they will happen. That would be my strong prediction. And that will force the industry to have similar set of rules for any kind of financial products.
Looking ahead, let's say 10 years, how do you think private equity will evolve? What changes in structure, strategy, or regulation do you predict will shape the industry's future?
It's going to converge towards mutual funds because of regulation. Regulation will impose to have standardized track records, standardized ways to calculate fees, and so on and so forth. It will. It's the same, again, like you can take a parallel. 100 years ago, mutual fund industry was exactly like the private equity industry nowadays. People were saying there's no need for regulation or anything like that. And then comes the 1929 crisis, and people are like, hold on, like the mutual fund manager can actually do that? And like, can they like actually hide that kind of information? Are they free like to calculate returns the way they want? I mean, like, surely this is wrong. And so this is going to be, I think, the same mechanism.
Well, now for our sports fans, how do you see private equity's increasing involvement in sports franchises shaping the future of the sports industry?
It's very interesting because at first it's a bit counterintuitive, because if you think of private equity, so for example, my town soccer team is held by an American private equity fund, and the so far, it would always be like the richest guy in town that has it as like a prestige asset, right? So the person would lose money investing in my local sports team, but he wanted to be the guy who, can invite his friends in the best eats and so on, right? So so how does it work if you have somebody who actually needs to make money competing with people who actually are happy to like lose money and they are competing in the same league, right? Like as an economist, you're like, I don't think this is smelling very good. As a profit maximizer, like stay away from this because these other people have deep pocket and are happy to lose money on it just for prestige. So like, get out. You shouldn't be here. Nonetheless, it looks like these people who did it for prestige have run these things in a very inefficient way, probably because they didn't care too much. And so there are efficiency gains that are pretty obvious and low hanging fruits. And so if we see how this American private equity firm has come to my home team and has professionalized it and made a number of changes in the way players are recruited, trained, and how they are talked to. It's a big deal, and so it does look like private equity has increased the professionalization of sport dramatically, also on the admin side of things. A friend of mine just actually left private equity industry to become a specialist of halftime talks. So he's taking that as like, in a scientific way, saying like what kind of talk works at halftime and which one doesn't, and how should you talk to players if they are winning versus losing, etc., etc. And he's getting a lot of traction. A lot of teams are contacting him in different sports and the like, because of, I think, that trend of people taking like all these things like very seriously and in a systematic way. And you have lots of statisticians hired by professional sports team to analyze, what is the optimal playing time for different people in different situations, etc. And I think that's been like there's been an acceleration due to private equity coming in. There are still some discipline where I don't see it. So like private equity have also like acquired the rights of some rugby league and things like that. I don't see how they're going to make any money out of that. And I still haven't seen anything concrete out of that. So I don't know really their play there. It could be also that there is a bit of also this prestige vanity aspect. Maybe some private equity fund employees wanted to be involved in their favorite team to control it in order to have some of the perks. Usually it's less frequent in private equity, but maybe in some instances it happened. So overall, it's more my overall attitude is I wait and see. Like there are a few of these moves I don't understand. I really wonder how they're gonna make any money. And for even the ones where they have professionalized teams, I'm not quite sure how much money you're gonna make in a universe where you're still competing with lots of people happy to lose money on it. So yeah.
Let's turn to your teaching at Oxford. How do you approach teaching private equity to students who may have no prior experience in this area? And what do you hope your students take away from your courses?
So most of my students wouldn't have prior experience, and particularly in the ones who do, they know a lot less than they think they do. So, um, the I usually I wrote a textbook that follows like my course in Oxford, practically laid bare, and the way I present is that I'm telling them I'm just going to teach them a language. The jargon is massive in practically. A third of my textbook is a dictionary, which I try to make a bit entertaining, so that it's less boring than reading a dictionary. And the entire book is written so that each sentence would have some jargon word that are bolded, and the sentence is written in a way that makes the meaning of the bolded word kind of self-explanatory, right? So that you just read it as a normal book and you get all these new words, but in the way it's phrased, you kind of understand what is it that they are standing for. Uh, so I very much present it as a language, and then you have some techniques, but it's a bit like a language too. Like you need to be able to write a financial model. That's a form of language, but you talk and present a case with a financial model. That's a way of speaking. That's just like you would write sometimes a mathematical equation instead of words because it's simpler. Um, so I this is how I teach it, and what I hope they learn beyond the language and is critical thinking. I'm a very critical person, maybe overly so, but I hope that they get half as critical as I am, so that they have this critical mindset, that they always question everything, that they know how to analyze things to get to like the root of the truth as much as possible. And then they don't, like so many people, just absorb war stories or get impressed by war stories, and that they have this very critical mindset.
Well, you have mostly undergraduates or graduate students in the courses.
I don't do undergrad, so I
Okay.
have master level
So,
students at minima, and I have lots of executives.
so that means you may have students who come back who worked as interns or worked before they went to graduate school, who worked in private equity funds. So there, your time had to be is unteaching or reacclimating them because they came in with they come in with those war stories and what they're taught in the with the firms they work for.
Yeah. So it usually doesn't take me too long, because I've been doing this for like 20 years plus. So I usually doesn't take me too long to tell them, like, I I'm gonna give you a few examples to show you that you off, okay, and then we get moving. So it is not too much of a problem. I rarely have people that are confrontational. They will quickly understand that there was a big piece they had missed, and they want to think about it.
Yeah, well, the problem is now universities like you to have class participation, and the problem is the participation is what you actually don't want your other students to hear. How do you think
Yeah, we
academia and
don't do that in Oxford, but yeah.
okay, how do, I'm sorry, explain that.
We don't do class participation grading, so there is lots of class participation in my course, because of the way I teach. I'm very thought provoking, so like, and provocative in general, and so like, because I'm provocative on purpose, then I trigger reactions, and there are lots of questions, and so my classes are like a Q&A effectively.
Right.
But like there, I do sometimes an hour and a half with just one slide. It's not like I don't lecture. It's like it's a Q&A. And but we don't do like this participation grading where like then everybody
Yeah,
has to like say something, and then they say
yeah.
not the answer. Yeah.
I'm not even talking about grading. I'm just talking about when you're teaching and someone will interrupt you with their experience in the industry. And that sort of sometimes takes people off their mark. How do you think academia and the private equity industry can collaborate more effectively to advance understanding and improve practices?
Yeah, so maybe controversially, is it to be slightly provocative again? Maybe they shouldn't collaborate. I'm not sure it's very healthy for academia and industry to collaborate, because something that at University of Chicago, Luigi Zingales has written, and extremely well, and he says it much better than I can say it. But he has talked about the capture of academics and the capture of regulators, and I think that's a real danger. We need to be very careful not to be captured by the object we are studying. And so I'm not sure we should encourage collaboration. There should be collaboration. We have seen some industry having some data that they share with academics, but the problem is that they choose the academics with whom they want to share the data, and they're gonna pick an academic that they trust are gonna say something positive about them, and that bias a kind of research output that we obtain. So I'm actually quite concerned about the involvement of the industry in academic research.
You have a wonderful podcast. I don't know how many times do you do it once a week?
So I used to have these practically laid bare podcasts. I have stopped. I've done a few recently, which was like AI generated, because I thought it was fun. But I kept these old podcasts. I use them for teaching because these are like interviews of practitioners, who have something to say, and each one has a theme that corresponds to one of the topics of my lectures, of my book. And so, there will be 2 or 3 on private debt. There will be a private debt in emerging markets. There will be private debt in developed markets, a small private debt players, and then another podcast with a large private debt player. There will be one with a banker that does leverage finance. Then there will be another podcast on ESG, and there will be another podcast. So each podcast has one topic.
Yeah, yeah.
So
I
hopefully
find
they
that
are evergreen.
interesting. Yeah, I find that interesting. Students, and you get this when we get feedback from students on their evaluation at the end of the semester. Having guest speakers in who are reliable guest speakers, and really helps close the gap between theory and practice. Students, about the biggest complaint students have is there's a big difference sometimes between what the professor is teaching and what goes on in industry. But sometimes you get controversies. Now, I don't know if you want to share this, but you recently had a run-in with someone, I think, in the private equity area, didn't you?
Well, there's a firm in private equity, yes, that caricatured me and insulted me.
Yeah. And I heard you came out way on top of that. Okay.
I'm fully.
Mark, listen, thank you very much. I realize you're very busy. Wonderful. And if and if this interview is any indication of how wonderful you are as an interviewee, you are as a teacher, your students at Oxford are getting a great education. And I
Thank you very much.
appreciate all the time you've taken. Thank you
Thank you.
very much. If you have any concluding remarks, feel free.
No, good. I'm just grateful. I think the questions you came up with were extremely good. They're original. I think most of them I hadn't never received before, and I've done quite a few podcasts as a guest as well. So congratulations, and yeah, thank you very much for organizing.
Okay, thank you very much.